The biggest problem with alpha is actually that every second year a different guy gets huge alpha. Everybody thinks that fund management is all about stock picking. So for a moment, look at where the last 5 years money has been made. In last 5 years, you have seen diagnostics, hospitals, asset management, wealth management.
Right.
The benchmark is not static. The benchmark in itself is a portfolio.
Yeah.
Usage of AI in times to come will increase. Our firm is young. Someone like me is not young. I've been in the industry for 26 years now.
Correct.
Right? So we have the benefit of having witnessed the entire history and seeing what has worked, what has not worked.
Hello and welcome to this very special series where we bring you insightful and exclusive conversations with some of the top voices behind India's mutual fund industry. And today we are joined by one such special guest, Mr. Aashish Sommaiyaa, who leads WhiteOak Mutual Fund. Thank you so much, Aashish, for taking out the time to talk to us. With this series, we try to understand the investment philosophies and strategies, that many of these fund houses in India, specifically during this time of where we are evolving and growing, how they're trying to build the whole strategies and portfolio around that, right? So just wanted to understand from your perspective, how WhiteOak has been trying to adapt to that whole India growth story while we are evolving towards the whole growth cycle, but also trying to keep in mind, obviously all the positioning and the strategies that you need to keep in place.
Yeah, so, great question to start with. So obviously we are a recent entrant. We launched our first fund in 2022.
Right.
It's nearly 3 years now. But if you take the length of the industry and many of the incumbent players, then obviously one would say a recent entrant. You're a young player, right?
Yeah.
But two things to keep in mind. One is obviously what excites us is that we are all fortunate to be in a market. We're not just the stock market, but even our regulations and dispensation is such that managed equity investing like mutual funds is also growing, very, very rapidly. So we are fortunate to be in an industry which is growing very rapidly. But of course, in an industry which is growing rapidly still, if you're player number 45 or 46, then what is very, very important is to, how do you differentiate yourself? Like what is it that you're doing differently? And, there are very many advantages on that specific front. There are very many significant advantages if you're a new entrant or a recent entrant.
Right.
Because you have 2 or 3 things. One, you have the whole history or the whole journey. So you know what has worked, what has not worked, what people have done right, what people have done wrong.
Right.
Right. You have the benefit of that experience. And obviously our firm is young. Someone like me is not young because I have been.
But you do have the experience.
Yeah, that's what I was saying, that I've been in the industry for 26 years now.
Correct.
Right. So we have the benefit of having witnessed the entire history and seeing what has worked, what has not worked. See, one thing which is very clear in our industry is that, there is inconsistency of performance. So, when you guys must be looking at mutual funds, especially equity mutual funds, what you must be noticing that it's not like there is lack of performance. It's not like there is no alpha. The biggest problem with alpha is actually that every second year a different guy gets huge alpha, and the inconsistency is the problem.
Right.
Alpha is of no use if a different guy produces alpha every year. You want the fund in which you have invested, you want to remain invested, and through your journey, you want that fund to outperform the benchmark. I mean, you pick one fund, when it's performing very, very well, you enter into a fund and then you find second year somebody else is the winner and, this is not even. So the winner rotation and lack of consistency, that is one clear thing. So we don't have dearth of high performers. We have dearth of consistent performers. That is one, serious scope for differentiation, which is the customer experience and the experience of the mutual fund distributors and advisors. So if you can do something in your strategy to impart consistency rather than, if you can optimize rather than maximize, it will improve experiences.
Right.
Similarly, if you see over the last 10-15 years, say 10-15 years back, fixed income was bigger than equity. But today it's completely tipped over. Fixed income is a smaller industry and equity mutual funds have become like 70% of the entire business. And as a result of that, what has happened is, again, we have dearth of conservative funds. We don't have any dearth of aggressive funds. We don't have any dearth of equity-oriented funds. We have dearth of funds which can give different choices to fixed income investors or conservative investors.
Right.
Right. The third thing is that even if you see product launches, what is happening is that the industry has kind of got on a treadmill. See, once you build your product range in a way that it is primed to be very cyclical, then you will consistently see cyclicality of your inflows and outflows. So let's take an example. At the peak of the market, if you launch a tech fund or an infrastructure fund, let's say infrastructure fund launched in 2007, example. So a lot of money will come in at the peak.
Right.
What will happen after 2 or 3 years? It becomes a leaking bucket. Everybody is unhappy, money consistently goes out. So what do you do now to get that money back? You launch more funds.
Right.
So the solution is not to keep launching funds. The solution is to launch funds thoughtfully so that people can stay with you longer. The other thing is obviously we differentiate heavily because of our team. So, most of the people in the audience, they may not be aware of WhiteOak. Right? People are aware of many mutual, there may be some mutual fund which are launched yesterday, people are aware of the name.
Correct, yeah.
Why? The reason is because in India, most mutual funds are launched by a conglomerate. Right? It's somebody who is a broking company or an NBFC or a bank or a insurance company. So you know the name. So you think that you know the mutual fund. You will not know WhiteOak because why you don't know WhiteOak? Because when WhiteOak got a license, the license was given to a professional fund manager. We are not a bank or an insurance company. We are a specialized fund management company which manages more than $10 billion. We are building our brand purely through performance, track record, and the communication and the philosophy.
Right. So, because you are obviously a young player, right, in this active fund management industry, just wanted to understand, the evolving part from here, especially keeping your philosophy in mind when you try to understand the opportunities in India.
Yeah.
How are you and your team of fund managers going about it?
Yeah, so that brings us to, when I said about differentiation, and like I said, one of the key tenets is the philosophy. So, and I also mentioned to you that there is lack of consistency.
Right.
So see, why do winners rotate? Let's understand that. And what is WhiteOak trying to do differently? See, first of all, there is a lot of song and dance about stock picking.
Yeah, right.
But today, I want to move beyond just stock picking because everybody thinks that fund management is all about stock picking. So fund management is a part of stock picking. And making a portfolio entails high quality stock picking based on certain principles that you follow. So nothing to take away from that. But when a portfolio is constructed to beat the benchmark consistently, then portfolio construction becomes equally important.
Right.
In our industry, everybody talks about stock picking when they talk about success stories. You hear a lot of folklore about somebody having bought some stock at a certain price and see what it became. You hear a lot of folklore about certain fund managers being great at picking small caps and mid caps.
Yeah.
We do have that capability. But what I want to highlight is that fund management is not just about stock picking. If you are doing fund management to beat an index consistently, it's a lot more about portfolio construction. You must have met many fund managers. When you ask them about their philosophy, they would tell you something like growth at reasonable price. They would tell you value, contra, small cap, mid cap, quality. So very quickly people, they familiarize you with their preferences, that what type of stocks they like to buy.
Right.
But if you see the index, the broadest index we follow is BSE 500.
Yeah.
Now BSE 500 is what I call Sarvagun Sampann, meaning that it has all types of companies, right?
Yeah.
It has growth, value, defensive, cyclical, domestic, export, PSU, private, large cap, mid cap, small cap, interest rate sensitive, non-rate sensitive, everything it has. Now let's take an example. If you followed 2018, 19, 20, everybody who had a defensive portfolio, full of pharma,
Right.
Consumer, tech, they outperformed. So let's say benchmark is here, and all these guys who had defensive portfolios, after COVID came, or 2019-20, all these guys who had defensive portfolios, they beat the benchmark by some 10%, 15%. They are the ones who were the top performers.
Yeah.
And all the guys who are holding cyclicals, PSUs, saying that this is where the valuation comfort is, I'm buying cheap, I'm buying contra, PSUs are cheap, right? They were all here. But we should not forget that the benchmark is not static. The benchmark in itself is a portfolio.
Yeah.
So what happened till 2020, this is what it was. Late 21, early 22, the Ukraine war started.
Correct.
When the war started, commodity prices, energy prices, coal prices, all of that went up. And all of that has a preponderance of all these cyclicals and PSUs. So what happened? first the benchmark was like this, all the defensives were here,
Yeah.
all this cyclical and all were here. But the benchmark in 2022 became like this.
Yeah.
Right? Something else started working. So all these guys here with 10% positive alpha became 10% negative
Negative,
alpha. And all these guys with 10% negative alpha became,
Yeah.
right? Now we should understand one thing, that none of this, what I showed you, is sustainable. The benchmark is always going to, benchmark is fickle. When the macros change, what works in the benchmark, which style, which market cap, which sector, when the macros change, what works in the benchmark changes.
Yeah.
So anybody with a pronounced style or preference for any tilt or preference for any sector or any factor, their performance will keep getting headwinded, tailwinded, will keep moving like this.
Yeah.
That's why winners keep rotating.
Right.
And that's why I said that fund management is not just about stock picking. It's a lot about portfolio construction. To beat the benchmark consistently, how you construct the portfolio is as important as what stock picking you're doing. So where WhiteOak differentiates itself is that we follow something called a balanced portfolio construction, right? We optimize our performance. I know that if I'm number one in alpha, it means I have only those things in my portfolio which are currently in trend in the market.
Right.
And if I have huge negative alpha, it means I have only those things in my portfolio which are currently not on trend in the market. But the market keeps rotating.
Yeah.
So you need a portfolio which is balanced. So sectors, factors, market cap of our flexi cap, multi cap, we keep all of that balanced or close to where the benchmark is. But our portfolios are 60-70% active. So the entire active weight is only at the stock picking level. So that lends consistency. We want high alpha, but we want alpha with low fluctuation of alpha. If you take a category of funds where, let's say, there are 24 funds, statistically you will say the top 6 are top quartile, second quartile, third quartile, fourth quartile. Our philosophy is such that if we do well, we want to be 4th, 5th or 6th. If we do badly, we should be somewhere in the 10th or 12th
Yeah.
bracket. We don't want a situation, if we are doing well, we are number one, and we are not doing well, we are out of the playfield itself.
Correct. I mean, the consistency part makes sense, right? Because when we talk about the alpha generation, it's also because we have been one of the best bull markets in our time, right? So generating those alphas, obviously fund managers do their part and they help you get that. But of course, it's been easier. The market has also supported you with that. So keeping that in mind, we've been trying to term it as the sovereign alpha because we're just trying to build the alpha from India's growth story. Do you think that only to continue? Do you think that's going to still be the biggest driver? Or do you think any other factors also emerging here? Because there might be economies where the economy might not be growing at that pace, but I'm sure the stock markets somewhere might be growing at that pace, right? So keeping that example in mind, if is our growth is just related to sovereign alpha? Is that what?
No. So I would say that India has not just the market itself going up. See, alpha, it's like this. If the market itself, if the economy is doing very, very well, and the economy has a construct such that private sector corporates or listed corporates can participate in the economy, then it's true that the economic growth will translate into stock market growth.
Right.
But what will happen? We are active managers. If there is stock market growth and the index itself is growing 12-13%, then we are in existence only if we can do few percentage points more.
Correct.
And like I said, few percentage points more consistently.
Consistent, yeah.
There is scope to grow faster also in portfolio terms. The reason is because India, and you mentioned about other markets, India is one of those rare markets which has huge level of heterogeneity. Okay. There is something which you should look up. There is a HHI index.
Okay.
Right. That HHI index basically is a measure of concentration.
Okay.
Right. So basically, what it will tell you is that in every sector, how much is in every economy, not sector, in every economy, how much is the top 2 sectors or the top 3 sectors.
Okay.
So first thing what I want to tell you why I quoted that index is that in terms of sector concentration, India is one of the most diverse markets. We have practically every sector and every sector listed. It's the most diverse market.
Right.
Of course, we don't have a high-tech sector. That hopefully will come with all this semiconductor and all the activity. When the guys like Apple start manufacturing and they do backward integration and sourcing, eventually in the next 10 years that may develop. But other than semiconductor and high tech, most sectors which are not there in many emerging markets, they're there in India.
Right.
So for portfolio construction to generate alpha, what you need is heterogeneity.
Yeah.
Right? If there is heterogeneity, then there is stock selection alpha. The research team can add that much more value. If there's lack of heterogeneity, right? Like in South Korea, for example, big part of market cap is just Samsung.
Yeah.
So your alpha will depend on how much of Samsung you hold or not and how it is doing. Correct? In India, there is no such thing. Maybe there is one odd company which is big, but maybe that is 9-10%. Otherwise, it's very heterogeneous, and that gives a lot of stock picking alpha.
Right, correct. So like the pockets of growth is actually from everywhere in India, right? And especially like not just banking and IT, it's also the new emerging, companies that are coming into picture. And we've been talking about like AI, green energy, EVs, trying to be the buzzword in the past 2 years. Do you see that only to continue in the next few years as well, or do you see certain new emerging, sort of sectors coming up?
Yeah, so see, sometimes certain things become a buzzword. And I'm sure usage of AI in times to come will increase. But if you just for a moment look back last 5-6 years where the alpha has come from and where the market has expanded, you'll be surprised to know that while we are talking about AI and very forward-looking sectors, and they will come, I have no doubt about it, but just for a moment look at where the last 5 years money has been made. In last 5 years, you have seen diagnostics, hospitals, asset management, wealth management.
Right.
People making shoes, restaurants. So what is happening is, one thing, while we are talking about the future and a tech-led future, the reality is that India was till very recently a poor country, and we are now moving towards being middle class.
Yeah.
So even in traditional industries, a lot of stuff which was subscale, unbranded, informal, is coming off scale.
Right.
Is becoming branded and is becoming more organized.
Right.
So for example, you didn't have listed hospitals barring maybe one, but now you have hospital chains.
Right.
And you don't have just hospital chains, you have even children's hospital chains.
Right.
And you have orthopedic hospital chains. We spoke about 45 or 46 asset management companies. There'll be time we'll have 100 asset management companies. But where are we today? How many are listed? Maybe 4 or 5.
Yeah.
Maybe 1 or 2 more coming. So, AI playing a role. I mean, I'm sure it will play a role in it will play a role in how businesses are conducted.
Yeah.
And I'm sure that will add efficiency to earnings and efficiency in terms of capital, right, over a period of time. And it will impact across industries. Maybe efficiency will go up, maybe PE multiples for those companies will actually go up. Many of those implications. That is something we will watch for. But even in the current set, there's huge opportunity.
Right. As you mentioned, many companies will have to also adapt.
Yeah,
right. It's not like we might have AI specific companies, but it will be all these industries who adapt to it.
The very same industries, but you'll be able to know that companies which make right use will be more efficient.
So we've been talking about the India opportunity, and most of the opportunity that we've seen in India is also like the China +1 strategy. Many of the sectors that we saw, right? But do you see any competition from another, like any other emerging market that might actually come to that pace?
See, India has a natural advantage. Why it has a natural advantage? Because we have a large consumer base, and somewhere down the line in the future, we'll have the largest labor base, labor force also. Correct? So for anybody to manufacture, it makes sense. We all have been taught in school and college that your manufacturing should be closest to your consumers or to your sources of raw material. So now the biggest consumer force, and of course manufacturing will be close to labor also.
Yeah.
So biggest consumer force, biggest labor force is here. Sourcing of raw materials, some we have, some we don't have.
Right.
Right. So that backward integration and that evolution has to happen. But I think we will become a manufacturing-led economy. The reason being that the world is already sufficiently invested in us.
Yeah.
When you say about competition, of course, some countries will lay out the red carpet and their processes might be faster. And in a democracy, everything doesn't happen clockwork. Because there are processes to be followed, there are constituencies to be influenced and constituencies to be won. Correct? So we have to keep patience. We have all the right ingredients. Whether we move fast or slow is up to us as a bunch of people. I hope we move fast.
Yeah.
Right? But I don't see any reason why we will not have a bigger manufacturing economy. While we are the natural market, but somebody may be quicker than us.
Yeah.
Still, I would like to believe that the preference will be for the natural market, and people who populate that natural market, it's just that they should have the right processes and the right, the right offerings for people to do it here.
Right. As so many interesting points that you made, that, consistent performance is something that we need to look for, and also how manufacturing in India is obviously going to be bigger and better. So that actually gives you confidence in India and India's market as well.
Yeah.
Thank you so much, Aashish, for your time. It's been a pleasure talking to you. So many insights that we've gotten from you.
Thank you.
We will see you on the next episode.